Hey everyone, this is Kirk here from Option Alpha and the first video in our Reader's Choice week that we're going to do here. So I'm really glad that everyone replied back. Got a lot of responses, a lot of different topics, but these were the topics that were most requested for the week. So as always, if you have another topic that you want covered, please add it to the comment section of this post and we'll try to get scheduled for the next week or the week after in January. So the first one we're going to go over tonight is a couple different strategies to protect option trading profits. Now I wanted to go over just option trading profits as far as long calls and puts and short or naked calls and puts as well. Because once we get into credit spreads, condors, butterflies, etc., those types of strategies can be a little bit different, and depending on the situation, you might want to entertain some different types of strategies. So let's just get right into it and we'll go to a chart here of the Qs for the NASDAQ. Okay, so we're on my screen here and I just wanted to go to a quick chart here of the Qs on for the NASDAQ here. And the reason I wanted to go to this chart is just because I think it's a real good stock to look at here for these videos. Pretty broad based. I'm not going to look at any individual stocks, but I'm going to use this index as an example. So let's say that you have short puts at a strike price of 50 and you've had these since November, I guess, and the market's kind of run away from you, which is good for the short option trader, right? You're collecting that premium up front and you want to keep that premium and not risk a huge loss should the market fall below 50. So one of the best ways you can protect yourself from profits and hedge yourself from a market fall, which would be the only thing that the market could do to really work against your position, would be actually to create or leg into a credit spread using that 50 strike put as one of your first trades. So you know that a put spread on the bottom side of the market, a credit spread, would be a short put at 50 and then you would go long a put at 49. So let's go over here to the trading tab, and I've already brought up the Qs, and this is the January options, and you can see the 49 strike is right here. Now you can see that the mark or the average price on these is about 2 cents. So for $2, you can completely create a limited risk strategy out of your short option. Now it's going to do two things for you. And I'll go back to the chart here. One, it's going to protect you from major catastrophic falls in the market as you head into expirations week. So if the market starts to fall, you're actually going to make money on this long put. You're not going to make a lot of money, but it is going to hedge some of your profits. The biggest thing that's going to do is going to protect you from, say, an overnight catastrophe where the market just opens and starts trading many hundred points lower and just busts right through your strike price there at 50. So this is a really good, cheap way to protect your option trades. Again, it's only $2. So if you sold this contract for, say, $100, it's worth putting out $2 and keeping the $98 and locking that in and using that $2 and think of it as kind of an insurance policy on your trade. Now again, this works on the top side as well. If you have, let's say, 60 strike calls on the Qs and you want to protect yourself from any further move up on the Qs, you can again go here to our pricing screen. You can see these 61s aren't even really trading today, but they'll probably be around $1 or $2. And again, this is a really good way to protect your profit. Make sure that if the market continues to rally towards your 60 strike price, that you have some sort of protection of your profit some sort of way from a long call option. Okay, so now that's the ways you can profit from or protect your profits for short options. Let's say that you actually have a long option. So if you were long a call at, say, 50, once again using that 50 strike price, you're long a call from 50 from, say, November. Now you've made really good money on this option. And again, we'll go back here to our trading screen, and let's say you're long the call and you got into it at, say, $100 or 1.00 here. Now you can see that the mark or the average price is $5.88, so you've made about $488. Now another good way to hedge this position would be to buy the corresponding strike put for these Qs. So you're long a 50 strike call, but you would buy a 50 strike put on the Qs as well. Now again, this is going to be a real cheap way to hedge your and protect your profits. Now I have to note and make a comment here is that you're not going to make dollar for dollar what you would make in losses or protect in losses what you would lose if the market were to fall, because that's really what you want to protect, is a fall in the market price. So if you did buy these 50 strike puts, you would make some good money if the market fell, but you probably wouldn't make dollar for dollar what you lose on these contracts. So that's just a cheap way to do and protect your profits. Obviously, another way to do it would be to move in closer and say get the 54s or the 53 options here, and you can see those are trading for 18 and $9 here roughly. So if you got those contracts, you'd be a little bit closer, and if the market fell, you'd make more money than you would if you had the 50 strike puts. So that's a great way to protect your profits if you're long. Again, another way and simple way, which we're going to cover later on this week in another video tutorial, is using stop losses. You can create a trailing stop loss or a specific stop loss for these options here at a 50 strike and let the upside room potential of the option continue, also capping in and locking a profit. So I hope this has been a really helpful video for you guys. Again, I just wanted to cover those basics on protecting profits, and really legging into credit spreads is a great way to protect profits for short option traders. You all know that we're big option sellers, and most of our strategies are focused on option selling. And so legging into a credit spread gives you the same risk reward potential as a credit spread would in the beginning, but you have a better profit margin and a better profitability of the trade overall. So again, hopefully this was a great video, and I look forward to doing the next one tomorrow night.